So good afternoon, everybody, and welcome to our April 23rd workshop, the day after Earth Day. And for those of you who are celebrating Passover, I hope you have a wonderful Seder last night, tonight. And with that, we will get started. Today's topic is Term Sheets 101, or the essentials of raising capital. I call it 101 because we try to make this as simple for you as possible. And please, if you do have questions, put it into chat or raise your hand and I will be moderating the questions. We have two presenters today, one of our partners and one of our associates here at the firm. I will let them do some self-introductions because they do that better than I do. And with that, it's my pleasure to introduce you to Kelly and Jordana.
Hi, everyone. I'm Kelly Laffey. I'm a partner at Stubbs Alderton and Markleys. And I also work very closely with the Preccelerator, which you probably are all pretty familiar with if you're here. Today, we're going to be talking about essentials of raising capital, particularly with a focus on venture capital financings. And in particular, we're going to focus on kind of convertible instruments, just given that that's what a lot of early stage companies use these days. I'm a partner at the firm, as Len said. I've been a partner here for 7 years, focusing my practice on venture capital financings and emerging growth, representing emerging growth companies throughout their life cycle, whether it be from incorporation, through financings, debt financings, M&A transactions, complex commercial transactions, and the like. And I am here with my associate, Jordana Kareem, and I'll let her introduce herself as well.
Hi, everyone. Great to meet everyone today. My name is Jordana Kareem. I am a corporate associate at Stubbs Alderton. I've been here for about 2.5 years. Similar to Kelly's area of practice, I provide legal advice to companies at various stages of the business life cycle, from the initial stage of formation to when the company wants to do capital raising through VC financing to when the company wants to sell or acquire another company in M&A transactions.
And Len mentioned this before, but just for anybody who joined late, we used to do this presentation in person, and it was pretty kind of casual, and we like to take questions as they came. It's a little bit harder to do that on Zoom. And so if you do have a question about something relevant that we're speaking about, and it applies kind of broadly to the group, please do put it in the chat, and Len, Jordana, and I will be monitoring the chat throughout the presentation. And so we will try to answer questions in real time to the extent it is appropriate to do so. If your question isn't answered during the presentation, we will get to it at the end. We'll go back and look at all of the questions. And with that, we will get started. So just a general overview of what we're going to talk about today, kind of the nature of a term sheet. What is a term sheet? Who prepares the term sheet? When can you expect to get a term sheet? Things like that. We're going to talk about convertible notes versus safes versus a price round financing, and what the kind of key differences are there when thinking about what kind of financing to do. And then we're going to go through the key terms of convertible instruments being primarily notes and safes, and then a price round equity financing. We do, as I said before, we do focus kind of a little bit more on the convertible notes and safes, just as the audience here tends to be pretty early, and that is what most early, like very early stage companies use. But it's good to know kind of all of it, because the convertible notes factor into your price round down the road.
Okay, so the nature of a term sheet, also known as a letter of intent, sometimes known as a memorandum of understanding, is a document that outlines the material terms and conditions of a proposed transaction. Usually it's negotiated at the initial stage of the deal and signed before the actual capital raising transaction occurs. It's non-binding except for confidentiality, no shop, sometimes exclusivity period provisions. Though it's non-binding, a term sheet does show serious intent of the parties to enter into definitive long-form agreements. Usually the deal terms are further negotiated, or sometimes the deal terms are further negotiated between the signing of the term sheet to the closing. And then it's really important to say in a term sheet that it is subject to the satisfaction of due diligence and contingent, again, upon the negotiation and execution of the long form documents. Some of the benefits, I would say, of having a term sheet is that it helps the parties to focus on drafting and negotiation of the definitive documents. It helps to enhance the deal stability and commitment of the parties. It sets out the binding provisions. And then also term sheets and long-form documents are kind of the foundation, as Kelly had mentioned. They set the precedent for terms of future rounds, and thus having a positive, solid term sheet and long-form documents will allow for the next round of financing to run more smoothly and quickly.
I'll just add to that as well. You know, we talk a lot about the fact that term sheets are non-binding, but at the same time, the point is to set forth the principal terms upon which the parties can agree, so that, you know, we're going into the long form process with a basic understanding of what the deal is. It's very rare for a term that's been agreed on in the term sheet to be completely renegotiated in the long forms. The long forms are more to get into some further detail and set out all the reps and warranties and things like that. So you just want to go into it knowing kind of, do we have a basic understanding of what the deal is? The other thing I mentioned in the overview, and it's not in our slides, is just kind of, a lot of people ask me who should prepare the term sheet, or oftentimes I'll have a company who's looking to raise capital and they ask us to prepare a term sheet, but they don't have, you know, a committed investor yet. And the answer to that is, like, it kind of depends on the context. If you're a company and you're looking to raise capital, especially from a larger number of smaller check writers, you might prepare a term sheet that will be used to sort of soft circle those smaller investors. You know, if you're raising $1 million, maybe you get 5 people to commit to investing 100,000, and then, you know, like, on the basis of the term sheet, and then you could feel a little bit more comfortable that you've got a solid basis of investors that have agreed to those terms to even move into a long form and do some, like, an initial closing. Typically, though, especially in later stages, you're going to get a term sheet from an investor, because an investor is typically going to set the terms, especially the key terms like valuation. And so you might expect to go out and have kind of deck presentation meetings and calls with investors, and then they might serve up a term sheet after that. So, you know, especially if you're looking for somebody to lead the financing and put in the 500,000 of the million, or maybe 750 of the million, then you should expect that the investor will provide and prepare a term sheet.
So what are the key differences between doing a convertible note raise, SAFE raise, or equity raise? Basically, it's the issue of offering future equity. Usually convertible notes and SAFEs are providing the offer of future equity to investors, compared to when you're doing an actual price round, you're giving actual equity to investors. A company may also offer other forms of securities, including warrants, partnership interest, membership interest, or combination of the foregoing. However, today we're only going to be discussing about notes, SAFEs, and equity. And then some of the key considerations to determine, you know, which type of raise you'd want to do. It depends on the size of the raise. You know, companies traditionally have used SAFEs and convertible notes in the initial series seed rounds or bridge financing. However, you know, depending on how the economy is, depending on, you know, given the interest rates, more and more SAFE financings and convertible notes are being conducted that are raising larger rounds. And then the runway provided by the raise, how much does your company need in order to be able to continue the business, in order to scale the business, in order to hire skilled key employees before it needs to do another round of financing? And then the timing as well, what stage of the company is it in? Is it in the earlier stages? Traditionally, you don't tend to offer investors full equity in the earlier stages, your angel investors in the earlier stages. And so it depends on the timing. Do you want to do a convertible note raise or a safe raise or equity? And then some of the other comparisons are also the cost and time. Safes and traditional convertible notes or standard convertible notes tend to be more cost effective since they have standard language and provisions, and it's easier to draft those documents compared to doing full equity rounds, which have additional definitive documents and can take longer to negotiate and agree on. And then also to consider contractual management obligations, and then certainty of ownership and share dilution.
So one thing that we recommend doing whenever you're doing any sort of financing round, whether it be a price round or a convertible round, is to set it out in like a pro forma cap table so that you can understand kind of what dilutive impact the financing is going to have. This is a very basic example of that, using very easy round numbers, so that it's somewhat easy to understand, but basically showing that like if there's a $9 million pre-money valuation and $1 million is invested, then the post-money is 10 million, and those investors would own 10% after the financing. That's what we call good dilution, because everybody is holding the same value both before and after the investment. But you're getting diluted from the whole. The founders are only holding 90%, but it's worth more because the post money goes up. When you're doing kind of basic calculations like this, we often do it in Excel, and there's lots of things that can go into it, and I think we might have another slide on that later. But basically, when you're thinking about valuation and dilution, like it's not just a number on a page. It has an impact in that you have to run the math to fully understand the impact. And if you're not able to do it, it's something that we help clients with a lot, just so that you can fully understand what's happening when you raise capital.
So two key terms that you tend to see in convertible notes and saves, and especially because these types of security instruments are used in earlier stages of financing, in order to incentivize these investors to invest in high-risk companies. You offer something called a valuation cap and a discount. You may offer, these documents may have one or the other, it may have both, but they only convert under the provision that results in the greatest discount. And then in theory, there may be convertible instruments that have neither, but again, in order to incentivize investors to invest in high-risk stage companies, you are offering both or one or the other.
So talking about one of the key terms is the valuation cap. And those of you who might be familiar with the Y Combinator safe might know that they changed their kind of template form of safe a few years ago from a pre-money safe to a post-money safe. This is also just another example of why doing a pro forma cap table and actually running some numbers and scenarios is really helpful to understanding the difference. It's simply a matter of what's included in the formula for purposes of determining the conversion price, and what shares get included in the fully diluted that gets taken into account when calculating the per share price. So pre-money includes all shares outstanding except for convertible securities, and includes any increase that might be in the option plan as a result of the financing. Holders of safes and notes get diluted by other convertible securities in that case, but they don't bear the dilutive effect of the pool. Whereas in the post-money, you include all the shares outstanding plus the shares issuable upon conversion of the convertible securities from other notes, including notes that might be issued after, like if you do one note round and then you do another note round before you move to a price round, all of those shares would get included, so they wouldn't be dilutive to the investors. But then you don't bear the dilution of they would not be diluted to the investors, but then you do get the dilution from the option pool because the option pool is not included in the fully diluted number. So again, it's a lot of math. So it can be complex to kind of think about conceptually, but that's essentially what the difference is. Neither is affirmatively better because it all depends on kind of the circumstances and how many convertible securities you have and how much of an option pool increase might you expect in connection with the round. But ultimately, it's just something that is important to understand when negotiating these terms.
So a discount is given to investors to help reduce the price per share to that paid by investors investing in the next equity round. Typically, discounts can range from 10 to 30%. And so what that means is that, if investors in the next round of financing are paying $1 per share for equity, and you give investors that have invested in convertible note or safe in prior rounds a 10% discount. They're paying 90 cents per share. And essentially, these early investors, cash will buy more shares compared to investors in the next round of financing. Again, as mentioned before, safe and convertible note documents can have both a discount and cap terms. However, the instruments will only convert under the one that results in the greatest benefit to the investor.
So liquidation preference overhang is not an issue I see as much anymore, but it's still something I like to explain because it's just helpful to understand why when you go to do your price round, you're not just necessarily going to just sell Series Seed Preferred. You're going to sell Series Seed 1 and Series Seed 2 and maybe Series Seed 3, depending on kind of your convertible history. Preferred stockholders get a liquidation preference on their invested money in. That's the kind of key component of preferred stock, is that there's usually a 1x non-participating liquidation preference equal to the original price per share paid for those shares. And so if some of your investors are getting shares of preferred stock as a result of conversion of a convertible note or safe at a discount, the question or the issue was, well, should those investors get the benefit of the full liquidation preference, or should they get the benefit of the discounted price liquidation preference? And, the market has answered pretty squarely the latter, that they only get the benefit of the liquidation preference to the extent they actually paid for it. So that's when you issue what's called a shadow preferred stock, which has all the same rights and preferences as the new money preferred stock, except that you have the liquidation preference is equal to the discounted price, as well as the conversion price for purposes of anti-dilution is also based on the discounted price, so that the liquidation preference essentially matches the money you actually invested into the company.
So I have a question here that might pertain, is cap a ceiling or a floor in terms of whether convertible notes or safe investors can purchase equity at a discount in later rounds?
So So a cap is essentially a valuation cap, which is saying, let's use an example to explain. So let's say you're raising $1 million at a $5 million valuation cap in a note. That means that in the price round following the convertible note round, like let's say, you raise your $1 million, it's been 18 months and you're ready to go out and raise the price round. You might raise your price round at a $10 million pre-money valuation, but those notes are going to convert at no more than the price per share that would be determined by using the $5 million pre-money valuation, because you already negotiated the cap on those notes. So the new money investors will pay the price based on the 10 million, and the notes will convert at the price based on the 5 million. So it is a ceiling in terms of how those notes are going to convert in the next round. Someone's also asking about a cap table. A cap table refers to how the ownership of your company is held. So a cap table usually is put together at the very beginning, and then it changes throughout the course of the company's life cycle. When you raise money from investors, they get put on your cap table as shareholders or members in an LLC. And if you issue equity to employees or other service providers, those folks would also get put on your cap table. So your cap table is broadly a reference to the ownership metrics of how the company is owned.
All right, thank you. There's one more question in there, but I think we'll take that one at the end, and because it's a specific example about a company.
Okay.
So some of the other terms that you may see in a term sheet when you're doing a convertible note or SAFE financing include side letter request. Side letters usually are provided to certain investors that include participation rights for future rounds, board observer rights, and similar certain rights to those investors. You will also see the maximum raise size for this financing. And then sometimes you may have information whether this financing will have additional closings. And so you have a maximum raise of 10 million or 5 million, and you may close at 3 million and you continue to do additional financings until you have to go back and amend the documents. You may also have maturity date and interest rate, especially for notes. And then for convertible notes, since they are debt instruments, you have information on whether the debt will be subordinate to debt of other banks that a company may have, financial institution, or other third parties. And then also approval requirements, how much is majority approval required, supermajority approval required in order to amend the documents before you can, let's say, again, do another financing round, or you might want to amend the terms of the provision. So what type of amendments what type of approvals are required to amend? And then certain investors may also have blocking rights. Basically, this is usually given to lead investors in order to, investors usually will have approval requirements before documents can be amended, or if a company wants to increase the size of the round. And so that information usually found in a term sheet as well.
So there's a question
I thought, Len, I'll touch on it because I wanted to anyway. So I do want to, I think we talked about, or we mentioned it earlier, but just to go back to clarify, the primary difference between a convertible note and a SAFE is that convertible notes have a maturity date and they bear interest. A SAFE, and because of that, it's a debt instrument, and people who hold them are creditors of the business. A SAFE has a lot of similar components to a note, except it doesn't have any specific date on which it matures or would ever be repaid back, and it doesn't bear interest. A SAFE is, the actual agreement is called a simple agreement for future equity. It's just a contract that says on the occurrence of these specific events, this will convert into equity based on the agreed terms.
Agreed.
So the question about can you amend the note to extend the maturity date, that was the question that was in the chat. You absolutely can. It goes to Jordana's note down here about what approvals are required to amend, because in my earlier example, if you have 10 investors that have each invested 100,000, if you need all of them to sign off on that amendment, that's going to be kind of a pain in the butt. But if you can go to 6 of them, that's still going to be a little bit of a pain in the butt, but at least it's a little bit less. And if you have a lead that invested 500,000, then you just need that person plus one more in terms of getting the majority of the principal to agree. The question about can you request that they it would basically be an amendment and restatement of the note into a SAFE so that they are no longer creditors of the business. You could certainly ask that they do that, and then you wouldn't have a maturity date to worry about, or have this sort of looming deadline to raise additional capital. But a lot of investors will probably push back on that because they want to be in the creditor position. They want to be kind of, even if it's unsecured, unsecured creditors, unless there's any secured creditors, are first in line to get repaid in any sort of insolvency proceeding. So, those are things to keep in mind. Safes are just in general much more company friendly, much more flexible for the company in terms of the timeline and horizon to raise capital. One question I've gotten from a lot of my own clients that are raising in safes is like, well, what if we never need to raise money again? Like, what protections do investors have then? And I have actually seen a couple times, it's rare. It's certainly not like a common provision, but I have seen a few times adding some kind of optional conversion right after 2 or 3 years, if for some reason the company never needs to raise capital because they're able to kind of operate based on revenues generated. So those are some things to keep in mind. But I am seeing a lot more notes in this market, just given, it's a little bit of a tough market right now. So I wouldn't be too gung-ho on the safe if somebody's offering a note. So sorry, I'm just looking at the questions. The one question is for convertible notes, is it typically either a discount on future equity or interest payments, or is it usually both? So a note always bears interest at some rate. That's a negotiated term. And there's in a venture-backed, venture capital kind of type of note, I've never seen interest payments, like periodic interest payments due, because usually an investor will want the interest to simply convert along with the principal in the next round. And so they get the discount as to the outstanding balance, both principal and interest. The next one looks specific, so I'm going to save that to the end. Okay, so now we're moving on to equity financings, also referred to as a price round. Basic economics of a price round: you negotiate a pre-money valuation, you divide that by your fully diluted capitalization to come up with your price per share. You determine, based on how much you're raising, how many shares you're going to issue at that price, and then you get to your post-closing fully diluted capitalization. It also, a big consideration here is whether or not you'll have an increase to your option pool. That will also increase your post-closing capitalization, and it changes the post-money. So sometimes you'll see an investor negotiate on the basis of the post money because they want to make sure that like their percentage is, what they invested divided by the post money valuation that they're expecting. Because the option pool increase gets included for purposes of determining price per share. So again, below are some examples of calculations. If there's, a requirement that the option pool be refreshed to a full 10% available pool. Len is recording this and like will be circulated after the presentation. So you're welcome to kind of revisit this, but this is just a kind of example calculation for education purposes.
And then after an equity round, one of the key considerations that a lot of companies will look into is how much typically do investors own post-closing if it's fully diluted. So this varies very wildly in terms of, the ballpark can range from 7 to 15% for a Series seed raise, sometimes 25 to 35% for Series A. Founders still continue to generally own a majority along with, early common stockholders and hires to continue to own a majority after a Series A raise. But again, this just ranges. It just depends on a lot of the key factors that will be discussing here.
Yeah, I'll just add, we say it varies widely, and I want to highlight that because the seed financings I'm seeing now also are growing in size. So like what used to be considered a Series A is now more of a Series seed. And so sometimes you have like a $6 million Series seed financing, and anything below that is more of a convertible thing. And so it's just, this varies extremely. We also see sometimes 25 million in a convertible financing. So, I wouldn't take this as gospel in any way. I would say the numbers are probably trending up more than down, and especially in what is an investor's market at this point. So we touched on this a little bit earlier about kind of what are the key terms of a preferred stock financing. One major feature of preferred stock is liquidation preference. Typically, it's 1x non-participating. If it is participating, that just means, so non-participating means, they get the benefit of the liquidation preference until the value of the company would get them more in terms of their pro rata on a percentage ownership basis. If it's participating, it means they get their money back first, and then they also they participate on a pro rata basis. That can create a little bit of a snowball effect if you're doing that round after round after round. I still see 1x non-participating as the market standard, while investors are taking a lot longer to commit and to actually close on deals. I have not seen much movement in terms of this particular term, so I would just take that for what it's worth. Sometimes you'll see dividends in a term sheet. They're usually non-accruing, which means that they're payable only if declared by the board. This is not something I argue over ever because the board is simply just not going to declare a dividend in most cases. Anti-dilution protection is a big one, and it's very complicated and beyond the scope of this presentation. But I would just say that in terms of a term sheet, you want to make sure that it's broad-based weighted average, which again is definitely still the market standard. If you see something that says full ratchet, definitely reject that like unseen. And then another really common term is preemptive rights, or what are called pro rata rights, which is the right of the investor to invest in the next rounds. Basically, if you have a first investor coming in and they are going to end up with 5% of the company after the financing, they want to have the right to maintain that 5% ownership through additional rounds by investing more, and that's further math and a further calculation, but basically whatever they need to invest to keep their 5% going forward, they want to have the right to do that.
A term sheet should also describe protective voting rights. Usually these are certain rights that are provided to preferred stockholders, sometimes to certain classes of preferred stock. You know, if you've done a Series A and then the company is planning to do a Series B, the Series A will have these protective provisions. These protective provisions usually include the right for the preferred holders to vote or approve certain fundamental transactions separate from the traditional rights that they may have to vote with common stockholders. And so these include some of the key fundamental transactions include, having approval rights for when a company wants to sell, when the company wants to offer senior stock, if the company wants to amend the charter or bylaws that adversely affect the investors, if it wants to pay dividends, repurchase stock, change the board size, or incur debt above a certain threshold. It's important to include that the protective provisions will terminate if a certain amount of outstanding shares of preferred stock fall below a certain minimum threshold. And then the voting rights may also include certain matters such as management compensation, change in executive officers. It's also important that the term sheet includes, what are the approval, what is the threshold to approve? Is it a majority threshold approval? Is it supermajority? And do any of the other investors have blocking rights?
So some other key terms that you might find in a equity financing round or other rights and restrictions, stockholders. So one common thing that's negotiated at a price round is the board composition. So I am seeing some early seed rounds where there's no board seat, but just like a board observer, right? But more often than not, if you're at your seed stage or your Series A for sure, you're going to be starting to give up 1 or 2 board seats. This is something I like to advise people of early on as well, just because, when you're thinking about constituting your pre-financing board, you might want to think about, okay, well, I need to have at least 3 or 4 on the board that are sort of my common directors, people that are aligned with me and are going to follow instruction from me. So that way, you're not giving up control of the board too soon. If you only have 2, then it's harder to argue that you should add more as investors are adding some. So it's just something I like to think about in the beginning. The other things that you'll often see is a drag along right. This means, if certain stockholders approve, usually it's a majority of the investors, a majority of the founders, and then the board, then the rest of the stockholders can be dragged into a change of control transaction, or required to vote in favor of a change of control transaction. And this is important because you might be granting equity to service providers. You might have people who have, very small portions of stock, but it's important that they be forced into a sale if, all the key players are in favor of that sale. So you don't want like a few tiny holders kind of holding out and not allowing that sale to go forward. You also often see transfer restrictions on founder stock. Investors really want to make sure that founders are properly incentivized and are going to stick with the company, that they're not going to be, selling a big portion of their stock and then piecing out. This is, again, you might also see that, they might want you to subject your stock to revesting or some kind of different vesting schedule than what it's on for the same reason. Other things would be information and participation rights. The participation right is really the pro rata right that I referenced earlier, but information rights include, rights to financial information, rights to updated cap table, the budget sometimes. And so, that concerns of sensitive information can arise in connection with that. So we do typically like to restrict that to only the major investors and not every person on the cap table. But those are some very common ones that you will see.
Kelly, there's some questions here on the different classes of shares. Could you reference that question and see if
Yeah, hold on.
it says, could you provide more information about different classes of shares such as Class A, Class B? Additionally, when these classes, do founders typically create these classes to protect themselves from being fired by the board?
Yeah, so, well, the best thing you can do to protect yourself from being fired by the board is to retain control of the board. And at a certain point, it might be useful to have maybe an employment agreement in place where if you were fired without some kind of cause, or there's something occurred that you terminated your service for good reason, you would leave, you would have some kind of severance, the company would have a severance obligation to you, which would make it, unattractive to fire a founder without cause. But the best thing you can do to ensure that you won't be fired by the board is to retain control of the board. In terms of different classes of shares, what you're referring to is like special voting shares for the founders, which I'm sure people are familiar with. Like Facebook did it. They had like a super voting common, which allowed, I believe, the founders to retain control for a certain period of time over the investors. I would say I wouldn't do that unless and until you have investors that are willing to agree to that structure. And that's usually only the case when the founders have proven that they are very, very critical to the business and that they're already having some success with the business. The reason why I say not to do it is because every founder that we've helped put that in place after being advised not to has needed to roll it back when they were raising capital, because investors generally just don't like it and they'll make you get rid of it before they invest. So it's not something I recommend doing at the outset. It's something I recommend doing once you've had a good level of success and have proven yourself to be critical to the business, and then you can negotiate it with the investors that you would retain some control.
And the answer is thank you.
So there's one question in here about extending pro rata rights to stakeholders. That's actually pretty common. There's actually a side letter that Y Combinator put out that has pro rata rights. I wouldn't say you have to offer it to everybody. You could say this is going to investors who invest at least, a certain amount based on the size of the round in total. Pro rata rights are generally, just speaking, like everybody wants them, but at the end of the day, it's usually not an issue where like people are fighting off the prior investors to invest. It's like they're usually going to the prior investors and saying, please participate in this round. You can have your pro rata plus some. Now, if it's a really hot company, that might not be the case. So you have to weigh those considerations, but the pro rata is usually not a huge issue, and it's also not a huge problem to get it waived if necessary. Let's see.
Kelly, one of the things that comes up when I'm meeting with founders is, hey, I downloaded my term sheet from some website or some online portal or from Y Combinator. What are some of the advantages of doing that? What are some of the disadvantages of kind of taking a boilerplate term sheet?
So Y Combinator is very widely used, and of course, I think you should seek legal advice to do your financing correctly, but I'm not going to say that I have an issue with people using the Y Combinator form because it's quite broadly used. That said, securities generally have to be approved by the board. And so you should document that in some way and or seek advice from your counsel to make sure that's documented in some way. As outside of the Y Combinator safe, I've seen some real problematic stuff out of ChatGPT and other kind of places like that. So, this is critical to your business. So I think it's important to do it right and to have the right advisors and advice. So yeah, I wouldn't, outside of the Y Combinator safe, I wouldn't just be taking things from the internet.
Thanks for that answer. We have two questions that are more, I guess, case study type questions pertinent to particular businesses. So Heather Stewart asks, my startup has been bootstrapping since June of 23. We have five people on sweat equity, tech, marketing, and operations. We have invested time and incremental costs associated with such marketing tools, tech needs, and legal. Can we show this towards the valuation? We are raising $600K and looking to do a non-priced round safe note.
Can we show all the work that's in
I think they're trying to value sweat equity and expenses as part of the valuation of the company.
Yeah, I mean, look, so this is also a question we get asked a lot about is how do I value my company before I have revenue or any sort of financial performance metrics to, come up with some kind of number. And I don't really have a good answer other than what can you say with a straight face and what can you defend? And a lot of companies are pre-revenue and are raising capital successfully, and it's because they're showing the value of their team, of their product, of their tech. And usually you're putting together some kind of financial model of what you expect to make in revenue or how you at least have some idea of how you're going to make money. But all of that goes into the what can I say the value of my company is with a straight face.
All right, thank you. And then Max asks, suppose you're raising $500,000 through a post-money safe with a cap of $5 million, and you attract interest from multiple investors totaling $1 million. You've already received wire transfers from early investors amounting to 100 and 300 based on your initial goals. What should you do next?
In this market, I'd take the money. I'd increase the round and take the money. You're going to bear more dilution. It's really up to you. I mean, but I don't think it's going to be there. If the question is, can I change the cap because of the increased interest? I don't think that's going to work. I think you're getting that interest based on the terms you've offered. You can always increase the size of your round if you have use for the funds and can get interest from more investment. But that's probably what I would counsel any client of mine to do if they were in that situation.
All right, super. Thank you for that answer. Max, thanks you for that answer also. So I don't see any other questions. We have a couple minutes here. If anybody has a question, please either put it in chat or raise your hand and we'll recognize you. And if not, that's okay. We can call it a day. I think this particular workshop is something that's always very important because this is endemic to funding companies and knowing what the instruments are. So good job, Kelly and Jordana. Thank you very much. Oh, wait a second. How do we? I think I have an extra question here.
Yeah, I see some more questions.
How do you suggest we proceed when we receive a verbal commitment that is conditional upon first securing a certain amount of funds. As a founder, while we're raising a pre-seed round of funding, I'm also investing my own money into our operations. Should I issue a SAFE or notes to myself?
So on the first question, I mean, obviously you should try to secure the relevant amount of funds, but I would see if you can get that commitment in writing, which in a price round context is actually pretty common, where we have an agreement that the initial closing will be a minimum of X dollars of the round. And you can get, you can get investors to sign it, and then you just do the closing once that condition has been met. As far as the second question goes, it really depends on the circumstances in your situation. A lot of founders put in obviously their own money when they're pre-financing, pre-revenue starting up. And a lot of investors view that as just like additional capital for your founder shares. If you're also issuing yourself a safer note, that means you're going to get preferred stock and you're going to get liquidation preference on that. And it's certainly better for you as a founder and as an investor in the business, but it's not always viewed super positively by investors. So it really depends on kind of how much it is, what it's for, and the circumstances of like your relationships with your investors, I think.
Thank you for that question, and thank you for the answer. Okay, I think I'm going to call it. And thank you both for your presentation today. Thank you all for who participated. I put in chat our YouTube channel if you want to subscribe to it, and that way you'll get alerted once this is uploaded. You can look at any of the other workshops that we've had over the years. So with that, thank you all, and that concludes our program today.
Thank you.